All right, let's just dive right into this top-down fundamental analysis of Keurig Dr. Pepper. Welcome to today's Explainer. We're going to look at exactly how a massive beverage giant manages to navigate a world of fluctuating commodity prices, highly aggressive acquisitions, and shifting consumer habits, all against the backdrop of a really volatile global coffee market. To really understand KDP's valuation, we've got a methodical roadmap for today. We're going to hit the global coffee squeeze, KDP's market dominance, their Q1 2026 earnings breakdown, financial health and debt, and finally, valuation and market sentiment. Starting with Section 1, the global coffee squeeze. We really have to start our story globally here, because the coffee industry is undergoing this brutal, unforgiving shift right now. If you're just looking at a stock ticker, you're missing the massive undercurrents completely reshaping the supply chain.
Take the collapse of Mercon Coffee Group. They were a top 10 global trader, and it's a massive cautionary tale. Despite having a pioneering $450 million sustainability-linked credit facility led by Rabobank, well, when the market turned, that sustainability link provided absolutely zero protection. Capital dried up in late 2023, lenders pulled the plug, and they were forced straight into bankruptcy.
So the crucial takeaway here is that external macro factors, think devastating Brazilian frosts or rising interest rates, can quickly force bankruptcy even on the most established players. Merck tried to maintain unusually high inventories, mostly to offset post-pandemic shipping delays. But when coffee prices for immediate deliveries suddenly started outstripping future contracts and those high interest rates began eroding their working capital, they had to liquidate stock at a steep loss. It's just a stark reminder of how fast the macro environment can crush a major player.
Moving to Section 2, KDP's market dominance. So how does a giant like Keurig Dr. Pepper actually shield itself from that exact global volatility? The answer lies entirely in their structural advantage. 80%. That massive number is KDP's approximate market share in the US premium capsule segment. It gives them an incredibly deep defensive moat. I mean, while European competitors like Nestlé and JD Peet's are busy fighting tooth and nail over market share, KDP just absolutely dominates the American at-home coffee landscape.
You see, competition isn't just about coffee bean prices anymore. It increasingly centers on proprietary formats. It's about getting a machine into your kitchen that only accepts their specific pods. By investing heavily in these machine ecosystems and brand licensing, KDP basically ensures that once a Keurig lands on your countertop, you are locked into their recurring revenue model. And that insulates them significantly from the raw commodity chaos we literally just saw with Mercon.
All right, Section 3, Q1 2026 earnings breakdown. Let's dig into the financials and see how this competitive moat actually translates into dollars and cents.
Looking at the numbers, you'll immediately spot this fascinating divergence. Top-line sales grew nearly 10% to $4 billion, but bottom-line GAAP net income plummeted almost 48%, down to $270 million. Now, at first glance, a 48% drop sounds terrifying, right? But you know how it goes in corporate finance. The devil is always in the details. We need to separate the routine operations from the one-off corporate maneuvers.
So when we strip away the massive acquisition costs that are heavily weighing down those GAAP numbers, we see that adjusted net income still dropped almost 7%. Why? Because inflation and increased marketing expenses are actively eating into their margins. Their adjusted operating income actually dipped by 1.9% to $838 million. So yeah, while that huge 48% headline drop is largely due to acquisitions, which we're going to unpack in just a second, their core operations are absolutely still feeling the very real pinch of higher supply chain costs.
But here is the real magic of their pricing power. Even as actual sales volume dipped slightly by 0.7%, they were able to hike prices internationally by over 9% to drive massive top-line growth. Seriously, when you can raise your prices by 9% and your customers barely blink, that is the ultimate test of brand loyalty and market dominance.
Moving on to Section 4, Financial Health and Debt. Let's look at the balance sheet to see exactly how this multi-billion-dollar operation is funded. Because let's be real, pricing power is great, but if your debt structure is flawed, it literally won't matter.
So while their debt-to-equity ratio sits at a very comfortable 0.88, that extremely low 0.24 quick ratio tells us they don't have a lot of liquid cash immediately on hand relative to their current liabilities. Usually, a quick ratio below 1.0 makes analysts pretty nervous, right? Because it implies short-term liquidity tightness. But to understand why it's so low here, we have to look at one glaring anomaly from Q1.
The reason for that low liquidity?
Well, there is a staggering $17.8 billion sitting on their balance sheet as restricted cash. It's locked away solely to finalize their massive acquisition of JD Peet's. This totally explains the huge transaction costs affecting their GAAP net income that we looked at earlier. They literally sidelined almost $18 billion in cash to close this absolute game-changer of a deal on April 1st.
Now, the crucial point regarding their nearly $26 billion debt pile is that the vast majority is locked up in senior unsecured notes. Think of this more like a long-term household mortgage rather than some immediate high-interest credit card bill. Over $20 billion of their debt is securely structured in these notes. And when you factor out that $17.8 billion in restricted cash, management calculates their effective leverage ratio at a very manageable 1.5 times adjusted EBITDA. So yes, they are heavily leveraged, but it is incredibly well structured.
And that brings us to Section 5, Valuation and Market Sentiment. Let's see how the market is actually pricing all of this data after seeing the macro headwinds, the protective moat, and that massive acquisition strategy. With all these heavy acquisition costs, inflation impacts, and slowing volume, we really have to ask, does KDP's stock price accurately reflect its reality right now? Are investors paying way too much for this market dominance, or are they actually getting a discount because of that recent dip in adjusted earnings?
Well, KDP trades at a 22.4 multiple. That cleverly places it right in the middle of the pack. It commands a higher multiple than your generic beverage companies, but it remains slightly cautious compared to its direct close peers. It's a fascinating spot to be in, honestly. The market clearly recognizes their superior 80% U.S. market share and that premium capsule model, so they reward them with a premium over the broader industry average, but they're still accounting for those bottom-line headwinds.
Now, for income-focused investors, KDP currently offers a really solid 3.1% dividend yield, and they're distributing about 68% of their earnings right back to shareholders. In a volatile market where macro factors can literally bankrupt lesser companies, having a stable, highly visible dividend that's supported by predictable subscription-style coffee revenue, that is incredibly attractive. And analysts generally agree that the current stock price is fair. It's acting as a balanced reflection of both their robust market dominance and their immediate challenges. As the folks over at Simply Wall Street pointed out, it isn't wildly undervalued, but it's also not sitting in some speculative bubble either. It's priced exactly like what it is, a massive, cash-generating giant trying to navigate a highly inflationary environment. So ultimately, you have to ask yourself, is the absolute safety of their consumer lock-in worth paying a premium for in an increasingly unpredictable global coffee market? As we saw with Merkin, the macro environment takes no prisoners. But as we see with Keurig Dr. Pepper's $18 billion acquisitions and 9% pricing hikes, a strong moat allows the company to not just survive, but to completely rewrite the rules of the game. Thanks for joining me on this explainer, and I'll catch you in the next one.